Hello, this is Dean Malone with ComsFX. I hope you're doing well today and getting some good trades. Again, I'm going to give you another trading tip on trading the dots Guppy method. And for those of y'all not familiar with this method, go over to www.compsfx.com/dots to learn more about this model. We've literally have hundreds of folks trading this model and getting some decent success. So I want to share with you another trading tip in identifying some potential setups and hopefully getting some more trading opportunities out of the marketplace. Now, as we look at the dots Guppy method, many of us understand that we're going to be trading the short-term guppies in the direction of the long-term guppies. So we see that the long-term guppies are moving down and the short-term guppies are below it. And we're looking for that movement down. But if you notice that we have this long-term trend more or less to the downside, but it seems like the market's really stubborn, not wanting to go down. And I'm reminded by what one of my trading mentors had said years ago to me. He said, Dean, regardless of what you do, never discount what the professional institutional traders are looking at and what they're trading with. And there's one particular moving average that I know professional traders are constantly aware of. And what that is the 200 moving average. And so when we take a look at the movement down on the dollar yen, and many of us were expecting continual move down on the dollar yen today, looking at the long-term guppies over the short-term guppies, and it would attempt to make a move down and back up, attempt to make a move down, back up, attempt to make a move down, back up. We kept hitting something that the professional institutional traders look at, and that is the 200 moving average. Now, what I've applied here is simply a 200 exponential moving average based on the time frame that I'm on right now. And we can see that the market has come down, hit it again, bounced, and hit it again, trying to push on through. Now, we didn't have a sell entry based upon this session from the previous evening, but you can see how the market literally just bounced along the 200 exponential moving average. Now, you could use the exponential moving average, or you could use the simple moving average, whichever you prefer. Most traders that I know like to use the exponential moving average because it puts the moving average closer in on price. But notice what the market's doing here with that 200 exponential moving average. The 200 exponential moving average is more or less moving to the upside, while the long-term trend is moving down, and that's why we're getting a bit of contention in the marketplace. Again, never discount what the professional institutional traders are trading with or using to determine how they're going to trade the marketplace. Now, it was curious to me today to see that we dipped below this 200 for a while, but then the market bounced right back up off of that, as if to say, well, we've tried it, I'm not really going to do it, we're going to head back the other way. What we want to look for as we trade is we want to make sure that what the institutional guys are looking at and trading with, that we are aware of that as we trade the dots Guppy model. It's a great model to trade with, but what I like to see is the bigger, longer term moving average often be in the same direction as what we're looking at in the long term and in the short term guppies. So I'll give you an example of that. We take a look at the dollar CAD. So you take a look at the dollar CAD, it had a nice little move down overnight, and this made a nice move down to the ST1, almost down to the ST2 level, sell target number 2 level, and took a little bounce back up and settled right here. So we knew where to enter, we knew a potential exit, and another potential exit, but notice up above, the 200 exponential moving average, again that's the 200 exponential moving average, is in the same direction as our long-term and short-term guppies. Looking at the Kiwi dollar, the New Zealand dollar, same scenario. Now, last night we had some strong news and caused a very quick move down in the pattern that we see here, but we were already made aware by the long-term guppies and the direction in which the market was going. We have the long-term 200 EMA going with it. Now, I'm only adding this to consider why the market may be obstinate sometimes, why it's being contentious and not wanting to progress in the direction of the long-term guppies. And that is simply, do we have a situation where we, the traders, are trading in a similar direction as the professional institutional traders? or are we trading more or less against the direction that they're currently looking at going? Again, we had a similar setup last night in the Aussie dollar. Now, the Aussie dollar has been pushing down, pushing down, pushing down, but it's getting to a point at the bottom of a large range that it's been in. And so we're getting near that bottom, which is right around that 140 to 150 level. What I mean by that is the 10150, the 10140 level. This is near a bottom here, and we're starting to see the 200 still to the downside here, but the market's trying to settle out and determine if we're actually going to break and go lower than 10150. I'm kind of doubt that we will. Though there's continued weakness seen in the Australian economy, I'm curious of how things will be tonight given the Australian employment number coming out this evening. We could see a potential move to the downside, and then what we'll look to see is, will the Aussie dollar, if it does have continued weakness and follows the 200 to the downside along with the professional institutions, will we get down to the 1.0 level, which is be parity with the US dollar? That would be an interesting thing, because I think that we'll find down near parity, or before we get down to parity, we'll find some bids in the marketplace to bid it back up, simply because of the interest rate in the Aussie dollar. Even though the Reserve Bank of Australia recently made an interest rate cut in the Aussie dollar from 3% to 2.75%, the Aussie dollar still leads all the major currencies in the world with a 2.75% interest rate. So if we find some risk on in the marketplace, we'll find movement back into higher interest-bearing currencies, and that would be a risk on sentiment. Even though some of their economic conditions are weak right now, we might see a push back up between this 10150 down to the parity level, might see that bounce back up. But what I'm getting at today is to monitor the market and sometimes look at what the professionals are considering. Are the professionals going in the opposite direction of what we see as traders coming down? Here's a long-term move to the downside. Professional traders looking at the 200. We get a little contention going on. Can't seem to break it. But when they're both in the same direction, it's a lot easier to trade, and we find ourselves in favorable trading conditions. Here, a nice move down. In this case, in the Kiwi, another nice move down. And in the Aussie dollar today, it did make a little bit of move down, bounce back and forth, because we're getting near a low in its overall larger range. Well, folks, this is Dean Malone with Compass FX. I hope some of the information I've shared with you about looking sometimes out at the 200 EMA might give you some additional evidence as to the overall direction in the marketplace. All we want to do is determine, are we in the same direction as some of the professionals when they're monitoring the 200 moving average. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.